Hi everyone, Clyde Bryant here, and welcome to a special episode of the Uptown Experts podcast. Filling in for me today is Luigi Chirocco as we discuss Uptown Asset Management.
Yes, thank you for having me. The people have been obviously asking, and well, here I am.
Thanks for coming on, Lou.
No problem, thank you. So what are we talking about today? I brought my cue cards because I'm playing the role of host today. We're role-playing today.
Yeah.
And we're going to talk about Uptown Asset Management, one of the companies within the group of companies, obviously. And why are we talking about this now? I'll segue you there.
Well, I think you're alluding to the fact that it's RRSP season, as we like to call it. RRSP deadline is fast approaching. This year is March 3rd, as we were discussing.
Weird.
Yeah, super weird.
So used to like the 28th. March 1st at times. March 3rd seems a bit weird.
Yeah, I had to fact check that one myself, I'll be honest.
It must be a Monday, I would think.
Yeah. So, and it's important because, being able to contribute to your RRSP or your retirement savings prior to the deadline, it's important for those of us that have accounts that or plans that we're looking to grow. And of course, RRSPs aren't for everyone, right? There are different types of registered products that people choose to use. And the benefits of, our asset management division or mortgage administration division is that it gives you the ability to invest using your retirement savings or your registered portfolio, as well as other means, which we're going to jump into, as we get into this. So, Yeah,
don't get too far ahead. I'm the host today. So, you touched on it a little bit there. So Uptown Asset Management is, I guess, something you've been working quite hard on to set up.
Yes.
And you said it, the highlight is being able to invest in Uptown, in our model, using registered funds, which is huge. That opens a whole new set of doors, I guess.
It's new opportunities for our investor base, because for the majority of investors that have been working out with us for now 10 years or almost 10 years, predominantly we've dealt in liquid investments, cash from accounts, non-registered, and this gives us now to go back to our investor base and have the conversations about their registered portfolios, right? Their RRSPs, their TFSAs, their LIRAs, their RIFs, and show them that we can do the same thing that we've been doing for almost 10 years with the unregistered side, with the registered side, which is, for us, it's very exciting.
So let's start at the beginning. For the layman or lay person, why is an RRSP beneficial? Let's start there.
Well, there's many benefits to an RRSP. Some would use it for retirement savings, long-term retirement savings. Some would use it to start saving towards a home because there's some benefits there. Some use it as a tax strategy to help reduce tax implications.
For sure.
So they contribute to an RRSP to help pay less tax. So there's various reasons why.
Or a combination of all those three things. Myself personally,
exactly,
I can make a contribution because I sort of figure out what am I looking at this year from a taxation standpoint, how much room do I have, what can I contribute, and then on the back end, obviously, I'm thinking about that day when it comes.
Of course.
How much I'm going to have. So
yeah, well, it's part of planning, right? It's all part of planning. And for a lot of people, we all think about, we want the house, the cars, the, 2.5 kids or whatever it is today. And, we forget about the retirement plan, or we start retirement planning too late, which unfortunately is what I see a lot, with the group that's getting close to retirement now, maybe, 55 plus, they're coming in and saying, I wish I started 10 years ago, or I wish you knew you 10 years ago. And those that are 60 are saying, well, Clyde, I wish you knew I knew you 15 years ago, because they started too late. So now the plans that we're looking to build are more aggressive in order for them to hit their retirement goal. But that's part of the benefit, it's part of the beauty of Uptown Asset Management, because it gives us the flexibility to build an individual plan with, I'm going to say, investment returns that are in line with your specific needs. And that's really the beauty of the whole piece. Because for some of us, it might be, I have 20 years to retirement. I can take a very conservative approach to my investments. And maybe I'm starting with 50,000, a small inheritance, whatever it is. That 50,000 can grow at a much smaller rate of return to ultimately get to wherever it is, the number that you're looking to obtain at that point in time. But for those that start later, we simply have to look at higher rates of return, which for us might mean secondary positions because we're mortgages. And that might mean a standard second position mortgage where we give a rate of 10, 11, 12%, 14 in some circumstances. And we model that against the risk for our investor. And so we have these conversations to make sure that they understand what it is they're getting into, the risk associated with it, and be able to determine, again, does this fit within your plan?
Yeah, you're touching on the actual lending side of it now. So you're jumping a little bit ahead. So I want to bring you back here just a little bit. So we can lend out your RRSP portfolio in the form of private mortgages.
Correct.
Not just RRSPs, by the way.
No.
So what else? RRSPs. What else can you offer?
Yeah, well, so RRSPs, TFSAs, which is again another great investment tool for those of us that have money, liquidity in the bank. You can utilize some of that liquidity, some of that money, put it into your TFSAs, and then now lend it out as mortgages at a higher rate of return.
And that growth is tax sheltered, which is beautiful.
Yes, yeah, exactly. It's a benefit. So instead of receiving whatever it is that you might be making now in your TFSA, you can look at mortgage investments as another option.
Yeah, and I know this is an RRSP discussion, but that I think is going to help a lot of your clients, because not everybody, I don't want to say believes in an RRSP.
No,
but an RRSP isn't necessarily a one-size-fits-all strategy, and a lot of people who perhaps think that they'll have a solid income at retirement maybe don't necessarily want to contribute from RRSPs, because then they will be taxed on the back end. If your income is going to be modest in retirement, let's say your CPP OAS, which, by the way, young people, that's not going to be around when you're time to retire. So you better start thinking of a plan to have some income in retirement. But if you're someone with looking for middle class, modest income, CPP OAS, maybe you have a work pension, but then after that it's topped up with just your own savings, right? Yes. So an RRSP is a great strategy for a lot of those people.
Correct.
Again, tax sheltered now, or it's not tax sheltered, but pay less tax now with your contribution. And then when you take it out, if your income is sort of not above, I don't know what the threshold will be 20 years from now when I hope to retire. But if your income is, that's why I say modest, an RRSP is a good way to do it. But again, the TFSA might be the better play for other individuals. So it's nice to see you have both. Yeah. And I know you have the ability to lend out in locked-in registered account.
Correct.
Because I have mine
there
as well. So that's nice as well. And that's truly a, what's your expression? Set it and forget it?
It's a set it and forget it strategy.
Because I can't touch that money anyway.
Exactly.
I have it.
Yeah.
I'm not going to see it until 60,
65.
God willing. And I have a 20, 25-year horizon for that to grow. So that's nice as well, that I think it's important that people know about, that people have these packages that they got from, let's say, their employer or whatever. So they have a lira now that they can't touch.
Exactly.
And they're in our age group or even older, but your time horizon's still long. You can still put that money to work for you in your model and lend it out in the form of private mortgages.
Correct.
And RESPs as well.
Correct. Yeah. So I like to say simply, any type of register investment that you hold, we can invest as a mortgage, right? And that's really the benefit, because now you're able to accelerate, like you said, even the RRSP, which if you get started while the kids are young, imagine how much you could accumulate in an RESP by the time they really need it, right? And again, same strategy. Maybe you started contributing late, and that's okay, but how much time do you have? How much money sitting there? At what rate of return, or pardon me, what is the rate of return that we can get for you in order to try to maximize that RESP? And it's something that we actively do today for some of our investors, and they're benefiting from it. So now we're trying to just really get the message out there that we can do that much more for that many more people.
So some people are fortunate enough to have a large amount of money that they can say, you know what, I'm going to make a large RSP contribution this year. What are some ways that, let's say someone who's, not living paycheck to paycheck, but they have good savings right now, but not anything, I don't have $200,000 that I can dump into an RSP today.
And that's okay. You don't need 200,000.
So what are some effective ways to, let's say, catch up if you started late?
The easiest way, if you're a homeowner, would be to look to potentially leverage that property, which we'll talk about in a second. But the easiest way would be to simply, contact your financial institution, maybe get an RRSP loan as really one of the quickest, easiest catch-up strategies. And then from there, small repayment terms. From the outside of that, as I said earlier, would be looking at potentially, taking some equity out of the home in order to make a large contribution if it is a sizable amount that you're able to contribute. For some of us, for most of us, let's be real, we haven't maximized what we can put into our RSP for a number of years. So there might be significant contribution space. And that's where you can have that, we have that discussion about, does it make sense to pull money from the home, maybe put in some debt that you might be carrying from other pieces, cards, whatever it might be, pull some money out for the RSP. And now, we do a little bit of balancing and show you what that picture would look like. So, these are sophisticated investment discussions, let's be honest, right?
For sure. But they don't necessarily have to be overwhelming. I think a lot of people get overwhelmed, or it's RRSP season and they think like, I don't have money to contribute to an RRSP right now. There's other things I need to do with my life, and I don't necessarily have the money in hand to contribute. But RRSP loan's a good one. Having worked at the bank, I've seen those very quick, and in some cases, depending on how they structure it, pretty easy to get the loan.
Heck, I think I logged in, sorry to cut you off. I logged into like my online banking. I won't give them the shameless plug. And it was asking me, you're instantly approved for your RRSP loan. I'm like, I didn't even ask for one, but I'll take it, right?
So if you're wanting to borrow more than sort of their threshold, then you do have to, of course, qualify and whatnot. But there are things like express loans where essentially if it's under a certain dollar amount, approved. Done. And some people look at those and say, like, I don't know if I necessarily want, because now I have another loan. But you have to think about RRSPs in a different way, right? So, number one, borrowing to contribute to your RRSP is a little bit different than borrowing to go on vacation or something, right?
You're borrowing to invest in your future.
You're investing in your future, but also what's that doing for your tax refund? So that's the planning as well, right? Exactly. So if I need to I'll use a small number. Let's say I go to the bank and I take a $10,000 express loan, which they'll approve for me before I even have a chance to use the washroom. So now if I contribute, assuming I have the room, right? Make sure everyone, you check your notice of assessments for your RRSP contribution room there. Yeah. But if I now take that $10,000 against, modest income, what am I getting back come April, right?
Exactly.
So in a lot of cases, don't think of it as necessarily now it's another payment. Think about what you're putting in versus what you're getting back. And then, I come from an old school family. Now you take your refund and you put it back.
You put it back.
Okay, you put it back.
Right?
So, in a lot of cases, these RRSP loans, if not the whole thing, but a good chunk of them are paid back
exactly
quite quickly, because you're able to take your refund and put, a large amount on it.
Exactly.
Or contribute more of your refund to the following year's RRSP, right? So that's a thing that people need to think about with respect to RRSPs, I think, is If you are borrowing for it, which is a very common strategy, especially our generation compared to our parents' generation, it's you have to look at it with a little bit of a different lens. It's not, I'm taking on a new loan,
No.
because there's the other side of it that you need to really look at.
Yeah, I mean, two sides of every coin, right? So for whatever it is that might be the quote unquote negative, what is the benefit? What is the positive? And in this case, the positive is, like we had said, investment in your future, having a more sizable or RRSP or retirement plan that you can then now move into different type of investments, like the one that we're talking about here today. Because for a mortgage investment to make sense, you're not going to start with a $10,000 registered portfolio.
No. And
right?
to be clear, when I'm talking about these loans and these amounts, these smaller amounts, it's not necessarily an investment for this product. It's just in general with respect to RRSPs and how to approach it.
Yeah. That's not something that we would look at from our perspective right away. But with that being said, we have investors that have come to us that have said, I'm a teacher and I'm a painter or whatever it might be. We have two RSPs, and one's 35 and one is 48,000. And
that they've saved
over time,
so far. Yep.
Or some of the money was sitting with Scotia or TD or RBC or whoever,
which is how most people start.
Exactly. Well, that's how they should start. Like we just said,
I
go into your bank, get an RRSP loan, start building an RRSP.
Young, safe.
Right? Safe, yes.
Yep.
Right? Get in there, build an RRSP with that, accumulate some extras with your TFSA. So now you're building a retirement plan. Now, once you have some type of savings, give us a call and we can review what you've done, what you're invested in, and likely what we can show you in terms of our mortgage investment strategy will be, or I will say will outperform the traditional investment strategy, right? So if the two parties come in again, 38,000 or 30,000, 48,000, whatever the number is, we would turn around and say, hey, yeah, together, that's enough that we can lend out a small second position, because people come to us for different mortgage balances. It's just understanding when that money comes in, how long will it sit, what happens during that time. There's a longer part or a much bigger conversation to be had.
That's a good point to maybe highlight, is a lot of people think mortgage and they know how much their mortgage is, balance, I mean, and maybe it's $300,000, $400,000, $500,000 in the GTA. The private side, when you're lending this money out, you just said it, we're not lending out $500,000 necessarily in the form of a mortgage, because a lot of these are smaller mortgages, smaller loans, second position mortgages. So
not all. But we have the ability to lend first and second positions. And by lending in second position, we have the ability to leverage or use some of these smaller account types.
And that's my point, is not to think that you need to come in here with $400,000, $500,000 because that's the type of mortgage people are looking for.
Correct.
Not the case.
Correct.
And plus, on the back end, I know you can combine. So let's say I have an investment and you have an investment.
Yeah, exactly. There's different ways that we can combine.
Lend together on
correct.
a property.
Yeah, so we can syndicate, come together, syndicate or come together and lend together. It doesn't have to be necessarily a first and second. There's various ways that we lend.
Ways, I know.
So, just to kind of answer the question, there's ways for us to utilize smaller investment accounts as part of our overall investment strategy.
I'm a mortgage guy, so I'm going to talk about the other option, obviously. Borrowing using the equity in your home.
Yes, and some do.
Very, very common, popular, makes a lot of sense for a lot of people. Off the top of my head, and I know I have things written on this piece of paper, this isn't one of them. For the client who's needing to play catch up, they bought their home like a good first-time home buyer at the first opportunity they could. They didn't necessarily go in there with a huge down payment. Maybe they even had RRSPs that they used to purchase the home, and they paid those back over the first 15 years. So that individual hasn't had necessarily the opportunity to save for RRSPs. You know, you buy a house, get married, couple kids, next thing you know, you're 35, 40 years old, and you're like, Jesus, I haven't really contributed to RRSPs.
My RRSP is not going to be my retirement plan. That's what you're saying to yourself if you haven't started.
Well, or I think a lot of people truly just aren't thinking about it.
Yeah, but that's part of the problem, right?
You know what? They know maybe they're not necessarily a sophisticated investor or have like an actual retirement plan, but I think everyone in this day and age with the media the way it is, social media, I think everyone knows they probably should look at how much they need to have.
Yeah.
So someone like that though, so the good job, let's say teacher. What was the other one? Plumber? They use teacher, plumber?
Yeah.
Okay. So good jobs.
Good jobs.
Probably stable jobs, thank God, especially in this economy.
Yeah.
If you have a stable job and you're not struggling to make the payments.
No, regular income.
Potentially looking to refinance your mortgage, maybe a HELOC.
Yeah, HELOCs are good options.
Second position HELOC, that sort of thing.
Yeah, especially, because interest rates are on their way down, variable rate,
Because it's a good way to catch up.
Yeah.
Right? You can take $100,000 out of your home, just throwing a round number, that you would never, you never come up with it, right?
No, not ordinarily.
And again, the two sides to every coin thing. A lot of people that I hear say, I'm just focused on paying off my mortgage.
Yeah.
Right?
That's
great. What's your amortization?
Yeah.
20 years. Fantastic. So you're 35 now, you're going to have your mortgage paid out by the time you're 55.
And then what?
Is that when you're going to start saving for retirement?
You got 10 years for the rest of your life.
So the power of compounding interest in general, the power of,
of course,
growth.
Yeah. Rule 72.
That may not necessarily be the best strategy for everyone.
No.
Now, again, if you are going to inherit a nice chunk of money, or there's some other aspect that we're not discussing now coming down the pipe for you, then maybe that's a fine strategy. But for a lot of people, I think they're focused on, oh my God, I have to get rid of this mortgage. And then I'll start thinking about, and they do this with their kids' education as well.
Yeah.
I think that is maybe a little bit short-sighted, and someone like that should have a chat with yourself.
Yeah.
To have a look at, maybe there's another way to do it, right? Because if you're managing your mortgage payments, rates are coming down now.
Exactly.
So a lot of people are looking at refinancing as a ways to maybe save money anyway, because they have a slightly higher rate. Rates have come down. Why not, if you have the contribution room, look at least what it would look like from a payment perspective, and then get started on saving for retirement.
Yeah.
So that's, again, mortgage guy. Obviously, there's some bias there, but
it's a good way.
I sound like I know what I'm talking about a little bit here. Anyway,
Yeah.
The other group of, I hear Evan snickering in the background. I do know what I'm talking about, Evan, when it comes to mortgages. Anyway,
you got the Uptown rubber stamp. You're good.
Perfect. Where is it? The other thing too is, I don't think we've ever discussed this, but I'll throw a curveball out. Ontario is not, they're not as landlord friendly as they used to be, and maybe not as landlord friendly as a lot of other provinces. So some discussions I've had with some clients, family, friends are, I don't want to be a landlord right now.
They're getting out of the landlord space.
For example, my dad, he's in his 70s. Whenever I tell him about what he should, he's like, I'm too old, Lou. I don't want the headache.
Yeah, I don't want to, no.
So he's older. He's not necessarily an RSP guy, but there's a lot of younger people that own rental properties, and they're like, I can't anymore in Ontario. Like, it's just, I'm handcuffed. I'm shackled. The tenant is always right. And no matter what, like, I'm gonna lose here. So a lot of people are maybe selling rental properties in this market, and they need a way to offset capital gains. Yeah. So you're selling a property. Hopefully you've done well on that property. You've said, I've made my money. I'm going to get out of this property, but now I'm going to get a significant tax bill come the end of the year with capital gains. So another way that someone could benefit from a tax perspective is save some of your proceeds. Don't go to the casino right after you sell, right? Because you're going to get taxed. But why not contribute a good size of money to RRSPs in that year if you have room, right? Offset that capital gain. So that's another
great idea.
Sort of, I know you like the word persona. Persona. Yeah. Someone who could potentially look at an RRSP contribution, maybe they're not thinking that way.
Yeah, 100%.
So borrowing for RRSPs, or this scenario, taking advantage of maybe a sale to contribute and offset your capital gains, and then you have a nice chunk of money there growing for you.
Yeah, 100%. Great ideas.
Thank you. All right, so I know we're probably a little bit behind because whenever we get together, we start chatting. We always go long. So the Uptown Asset Management.
Yeah, that's internal speak.
I'm using internal speak in public. So Uptown Asset Management.
Yeah.
So let's stick with RRSPs for now. Who's it for? Who's it not for?
Our investment is for that medium to high risk investor, or I should say high risk to medium risk investor, because at the end of the day, I mean, there's risk in everything. Let's just be real. And, people say, well, Clyde, medium risk. I'm not medium risk. I'm risk averse. And I would say, okay, well, what's your current registered portfolio invested in, right? TSX this, or, XYZ that, and, they fluctuate, right? They go up and they go down. They're not.
Don't jump ahead. I have a stock market question coming later. So
okay. All right.
Skim the surface, but please don't spoil it.
Well, maybe I'll just hold back on that one then. I'll just hold back entirely on it. But it's for the investor that understands there's going to be some ups and downs within the investment. Call those the highs and the lows. It's for the investor that has, a little bit longer of a time horizon attached to this investment option. If you're planning on needing the money in a year, it's not the right option for you.
Yeah.
Right?
So, okay. I was gonna say, my name's Evan.
Mm-hmm.
I'm a young guy. I have some money. I live at home, have some money, been saving, doing all the right things. I want to buy a house in the next 5 years.
5 years?
Is this something I should bring to you?
Yeah, 100%. I mean, in 5 years, the time horizon there is, 5 years is a long time, right? A lot can happen in 5 years. So I'm not saying if it's not 5 years, don't call me. That's not what I'm saying. But what I'm saying is if you have, 5 years in which you don't need access to the capital, the investment, the registered portfolio, or even just, the liquid cash that you have sitting in your bank accounts. If you don't need access to it, then give us a call. We can put it out for you at very specific rates of return that will outpace what you're probably getting. And, in most situations, we're providing rates between 8 and 10, 11% in some cases, right?
Now, what if I need that money to put as my down payment?
So if you needed to put towards your down payment within that 5 years, then...
Well, I don't know. It could be 4 year, it could be... I'm trying to paint this scenario of a first-time home buyer who's just
it happens.
Waiting.
It's a call that I get, right? And regardless of, what the plan is, plans change. Or as I like to say, life happens, right? So when life happens, we're always going to be there to pick up the phone. And the benefit of Uptown is, we have a large list of investors, one. We have access to capital, both internally through our mortgage fund, as well as other investors that we manage. So if you are in a mortgage investment and you are looking to be exited, or simple terms are, if you're looking for your RSP to be repaid, then within a reasonable time frame, we can actually have that done for you, as long as, of course, we can find the suitable replacement for your investment.
Okay, makes sense. And actually, I have a question related to that that I'll get to as well. So, long-term growth strategy, I think we've talked about here. So, truly, set it and forget it. I know that's the expression that you like. Is probably the way you should approach this.
Correct.
If you get fidgety after 6 months, if you're one of these people that are looking at the stock market and conducting multiple trades a month, maybe it's not for you.
Yeah, no, like our product, it really is a set it and forget it product. The only time you're going to remember that you have it is when, I give you a call and say, hey, there's some documents in your email, please sign off. We have a new deal for you. walk you through the deal, the good, the bad, the ugly, and, why we believe it makes sense. Because every deal that comes in, we review and we treat it.
That's a question that I think a lot of people want to know, or it's just maybe not a misconception, but it's just not available out there. How involved, if I'm an investor, how involved am I when a mortgage deal comes along? So am I go driving out to look at the property?
Absolutely not.
How involved is your typical investor?
Yeah, well, I mean, the simple answer there is it depends, right? But it depends on you as the investor. And again, when we bring in new investors, we have a sit down. They come here or we go to them, whatever it might be, and we have the sit down about the type of investment that you're looking to make. How active you want to be within the process. Some of our investors want to go and drive and see the property.
Yeah, I can imagine.
And they want to know that it's there and it's in good shape, right? Now, they're not walking in and checking the cupboards,
but I mean,
they're going to take a drive and check the neighborhood and make sure everything's good, and that's no problem. But some of our investors, they trust the appraisals, because we do go and make sure we get an independent third-party appraisal for every single mortgage deal that we fund. So all of our investors receive up-to-date an up-to-date appraisal that has a good value, or what we believe is good current value, that they can rely on. It'll walk them through, what the house looks like and all these other pieces that people are very curious about when talking about investing their money. And so, we'll walk them through the particulars of the deal, the financials of the deal. And then really it's, signing off on the various mortgage documents in order to get the mortgage registered, right? So it can be simple,
as involved as you want to be,
essentially. Exactly, yeah.
Which, if you're analytical like me, could be a good thing, could be a bad thing. Sometimes I might, over the top, too conservative. I look at something, I'm like, maybe not.
Yeah, I mean, again, for me, I've always treated my retirement portfolio like a long-term strategy where it didn't really matter what I was getting in terms of my return on a month to month. And, it'll be said sometimes in my current portfolio, within our mortgage investment portfolio, my retirement plan will sit for a month or 2, 3, 4. At one time, I think it even sat for 8 months, which is crazy. People are like, Clyde, you made nothing for 8 months. Yes. But it made sense to have that money sitting on the sideline, protected from market fluctuations. I wasn't sure what was going on with the real estate market, and I didn't want to have my money in the real estate market as a mortgage secured against property. Because if the market did turn, if I was on the wrong home, if I was on the wrong investment, then I would have lost money. So I took it out of the market and I left it on the sideline, like any good investor would do with the cash that they've put into the market. You take it off the sideline. Sorry, you take it out and put it on the sideline.
That's a good point. That's a good another way to look at it, because I know a lot of people with this type of investment, the concern is, how long is my money going to sit before it's moved? But that is the other side to this is, well, speed can sometimes mean unnecessary risk, or risk that's higher than what Uptown is maybe willing to take.
Correct.
So you don't want to find yourself as the lender in that situation now compromised because you're trying to move people's money out.
No,
so
that's not the approach I'm ever going to take.
No, and I think that's an important thing that we didn't really plan on talking about today, but it's something to highlight as well. The other side of when money does sit is, again, over the last, let's say 2 years ago, with the market the way it was, you had to sort of pause and say,
no,
I can't lend.
I did pause. Let's just be clear, right? For those that know me we took a big pause and we said, thou shalt not lend.
Well,
right?
how do you feel if you, let's say up until February of 2022, it looked like, people's homes were cash registers. Values were just steadily going up, insane amounts. And because of that, a lot of lenders lent to 80% of these inflated values.
Correct.
So the values were here. Lenders took chances and lent 80% of, let's say, the house value at that time. Now, in some cases, there was a 30-40% correction to the property value.
Yes.
And in a lot of cases, they still haven't gone back to
those
the
original
highs.
values, yes.
So imagine if you're an investor and you know that your money was lent out at 80% of some number over here that now is a fairy tale. That number doesn't exist. So now you might be underwater because of the aggressive nature of the lender at that time.
Yes, but the one thing I will say is, just like the stock market, profit isn't profit until you sell, and a loss isn't a loss until you sell.
That's true as well.
From
of course.
a mortgage investment standpoint, a loss is not a loss until that same home that you lent against, that would mean the people that were paying that mortgage would have had to stop paying that mortgage. They would have to have walked away from that home because the home would have been taken via the power of sale process. Right. And then we would have done an independent market valuation by at least 2 different appraisers to determine that this is the new value. And in that unfortunate circumstance, then the home would be sold on the open market, just, being able to be bid on by anybody, any realtor.
Of course.
And, it would be sold. And in on that event that, there was a shortfall, then that loss, unfortunately, would be realized, meaning you would lose. But again, the benefit of working with an experienced mortgage professional and someone like myself that's an accredited mortgage professional is when we write a loan, it's very sophisticated. And it doesn't stop at just the default. We understand that there are various ways, different recourse that you can take against an individual in order to further protect your capital, your investment. And those are the things that we utilize to ensure that our investors are thoroughly protected.
Yeah, that's a good point. Just because the value's dropped, you haven't realized the loss yet, right? If that borrower is still paying with time, how much time depends on the market, right? Downtown Toronto versus Georgina might be 2 different timelines. Yeah. But if that borrower is still paying and you're in it for the long run, then
you sit.
So what? I mean, nothing's really happened, right?
Yeah, exactly.
It's only in the event that, the house needs to be sold when it's underwater that you face these things. And actually, that's one of my, I wrote down a bunch of questions that a layperson would have. And that's one of my questions. So let me ask it now. So you touched on it, but what happens if the borrower, that my money is in their mortgage, I've lent borrower, my money, what happens if they don't pay?
If the money is in your retirement savings plan or any type of a registered portfolio, simply the registered portfolio doesn't get an additional payment that month. But this is why I call it the set it and forget it strategy, because it doesn't matter if your retirement plan, your registered portfolio is getting a payment this month, because you're not touching it this month. You're not taking the money out this month. You're taking the money out when you're 60, when you're 65. So you shouldn't be looking at it as, oh, they bounced a payment this month. That doesn't matter. In fact, that's a good thing, because the additional fees, the NSF charges, let's be real,
I don't know if you call it a good thing.
As an investor, that's a great thing, right? That's a great way for you to make some additional money. But my point is, it's not about the month-to-month payment. It's about the long-term approach. That's really what it's about. So
they stop paying at a certain point, just like a bank. If you stop paying, the lender's going to proceed to power of sale and do what they need to do to recoup that mortgage money that was lent out.
Correct, yes. So, the benefit of, again, our structure here is that the majority of the process is done here in-house. We have our real estate division here that's Uptown Realty, where we utilize it as part of the overall picture to help, one, making sure that we stay on top of values, and two, in the event that we do need to sell a property, we do so with the real estate division. Now, by doing so, we're also able to further protect the amount of capital that's going out against that investment. Meaning, there's real estate commissions that are collected.
You're not paying a realtor 5%
exactly
to sell
correct
that home if it needs to be sold, because you're the real estate agent.
Correct. We sell it. We'll be able to sell that property ourselves. I'm a licensed realtor, and we have other licensed realtors that work with us that we utilize to liquidate or sell the properties and maintain the profits in-house, right? It helps further protect the capital for our investors, which is what we are about.
Yeah, it's also giving you a bit of peace of mind if you're an investor and you do worry about the back end. Is okay, they have a process in place, they have a system, and they've thought of things like this where, okay, what happens if I have to sell? Now what? Do I have to go give this to a realtor to go sell? The realtor obviously is wanting to be compensated. So you've, your model certainly, obviously you've thought it through.
Yes, it's, as I said, 9 years, almost 10 years in the making here at Uptown.
One complements the other. Kind of like me and you, huh? So the stock market thing, what are the benefits of investing in asset management over not just the stock market, but let's say over the stock market or at your bank, in your bank's RRSP product?
Yeah, I mean...
And what are the drawbacks is the second part of that question.
Yeah, so I mean, the advantages of choosing a mortgage investment like ones that we offer here at Uptown Asset Management, if you are invested in, let's say if you are invested in the stock market, and I think anybody that lives in Canada, Mexico, really anywhere in the world, unless you're living under a rock, you have heard about the trade wars and the tariffs and, Trump and Trudeau, and it's crazy. And with all of that, I only talk about it because if you had your money invested in anything over the course of the last few weeks.
Yeah, Monday was depressing for me when I woke.
Yeah, it was, you were wondering what's going to go on and how do I get my money back? And, those fluctuations that happen when you have your money in the stock market are, things that you have to be, I guess, okay with. Because the money's in the market. It's going to go up and it's going to go down. And when it goes down, you pray to God, it goes back up. And, if you're invested in, I'm going to say the traditional product that you would find at most of your financial institutions, they'll give you stability. They'll give you that, maybe, I don't even know what they're offering now, 3%, maybe 4%.
Yeah, well, if you're getting an RRSP, GIC, it's
right. Pretty stable.
It's probably 3 to 4%, which is actually fantastic.
Fantastic, yeah. It's
historically,
guaranteed.
That's a fantastic.
Yeah, don't worry about it, right? Again, set it and forget it. You got 30 years. What are you worrying about, right? But, for our product here, it gives you the ability to say, okay, Clyde, I have 20 years left to retirement. I have $200,000, $50,000 that I've gotten from savings or, from a pension or whatever it may have been. And we can sit down and determine that if we can put that money out at an average rate of 10%, then that money is going to grow every 7.2 years. And if you have 20 years left till retirement,
grow double.
Pardon me. It's going to, I use the word grow. The money's going to double.
I knew where you were
every 7.2 years. So if you came in with 50 and now have you now have 100, and we're going to invest that 100, and again another 7.2 years is going to come back as 200. Now the benefit of that is that number was 50,000. Imagine if you started at 200, where would you be? And so we're able to take a very conservative approach to your investment, a conservative approach to your plan. And 7.2% as a mortgage, as a private mortgage, is very easy to obtain. And so, 10% on a private mortgage is very easy to obtain. And so we're able to outperform your traditional investment in terms of the rate of return. You get stability in terms of the rate because there is no fluctuation. It's a mortgage. It's a fixed rate. And you get security because it is a registered mortgage on title. So in the event of default or they stop paying, the mortgage must be paid out. So it gives you a lot of, I'm going to use the word protection, comfort when investing in your long-term future.
Yeah, I think also what you're not saying is, in a lot of ways, it's less confusing. I mean, the stock market can be overwhelming.
Yes. This
right?
is a simple...
If you're investing in one single stock,
yeah,
a lot of risk comes with that. You have to research the company, see what the projections are, and still, who knows what could happen. Or you're investing in, an ETF or something. So it can be overwhelming, can be a bit confusing, and at the end, there's nothing there that's tangible.
No.
You're invested simply in that stock. If that company or one of the companies, let's say, that's bundled in a fund goes belly up,
yeah, it's going to hurt.
well, you're left with nothing. Whereas with this, there's real estate at the end of the day that's securing the investment. So
correct.
It's a little bit more
only
tangible.
lend against real estate, correct.
And I think a lot of lay people maybe understand real estate and the mortgage market a little bit better than they understand the stock market.
Yeah, I mean, I still don't understand the stock market, if I can be honest with you.
And I think compared to a bank, what I'm hearing is safe, fine, but as far as rate of return, if you want to retire when you're 130 years old, no problem. But at 2.5%, 3%, 4% a year, I mean, I'm not going to be really reaping the benefits of that necessarily.
Yeah.
And I think one thing I want to highlight is it's not necessarily this versus that.
No,
a lot of our investors,
some of this and that.
They use this to diversify the portfolio
100%,
for
yes.
sure.
I always, listen, anybody that you sit down with that says, I want all of your money, run. And it's the same thing I say to every single investor that comes into it.
It's a good point.
Right? You should never have all of your money in one place. Even in mortgages, let's be honest, right? Unless you're lending at like 40% loan to value where, it's super secure. And even then, you never know, right? That anything could happen.
No, for sure. And that's the point of a know your client form and a suitability conversation.
Yeah, you're very technical,
there has to be at some point, if you're saying yes to everybody and their sister,
you can't do that.
Then you're not doing right by the client, right?
No.
There has to be a scenario where you're like, appreciate you thinking of us, but this isn't necessarily what I recommend for you. Let's revisit when you're in a different financial position.
Yeah, and we'll set you up with a plan that makes sense for you. That's the benefit of working with Uptown and the group of companies. It doesn't have to start with our mortgage investment division. It can start with a simple GIC. It could start with, a mortgage. It can start with any piece or any product that, we're able to work with you on. And then we can show you, the things that, the other things that we're able to do.
So a couple more questions. I know we're running short of time here. Again, layperson here asking a question. Costs, fees. What are the costs or fees associated with this type of investment?
Yeah, so again, and I hate to say it, but it depends. But if we're talking about the registered portfolio, fees and costs, generally those come from the registered portfolio. Specific numbers I don't want to necessarily say, but all the fees and charges are covered as part of that mortgage investment. So if there is going to be, let's say, an estimated fee of, $25 per transaction, then that fee would be covered with the mortgage investment.
You're talking about when a specific mortgage is in place.
Yes. Yeah.
So what about other costs? Annual fees?
Yeah. So
accounts need to be serviced.
Yeah, of course. Like anything, like any type of registered portfolio or any type of investment, there are going to be fees that you'll need to pay in order to maintain your account. So again, once we know kind of what you are looking to do, then we'll talk to you about what those fees are depending on the product.
You kind of touched on this, so I'll skim past it. But if my plans change, can I get my money out?
Yes, 100%. So again, they are mortgage investments, so it's not, call me today, get it tomorrow.
Yeah, of course.
That's just simply not the way the product is designed.
But nobody would say that because when they come in the door,
exactly, we're doing
a
our
realistic
job.
Expectation's been set to explain how this sort of works.
Exactly. This is why the majority of our investors, they're not making that phone call, but if and when that phone does ring, the answer is going to be yes, because that means something happened.
Yeah,
and,
exactly.
That's where, we do what we have to do to step into to protect our investor.
So the answer is not no, but obviously you would have explained to them how it works, and
yeah, I mean
it's not overnight.
Yeah, that goes back to we take a friends and family approach to our business here at Uptown, right? And we make sure that we really do take the time to get to know our client in order to really build the right financial plan. And it doesn't matter how they come to us. We want to make sure that we set them up the right way.
I'm going to challenge you. Why Uptown Asset Management over other mortgage administrators out there that can do something similar?
Yeah, I mean, I kind of just touched on it. We really take the opportunity to break down the individual investor. It's not a one-size-fits-all. For the majority of the investors that come in, not majority, all of the investors that come in have different time horizons that they're looking to, different time horizons in which they're looking to obtain, that number. And so we'll sit down and explain to them, in order for us to give you this, 10% return on your investment, that means we would have to put you into this type of investment profile in order to, get that retirement plan to the number that you're looking for by that point in time. So again, it really is more of a tailored approach versus a one-size-fits-all. Our investments strategy is very different than a lot of mortgage investors. We are very conservative, and the way that we lend, again, gives us added protection in our investment process, I'm going to say.
And final question, what is one tip that you would give everyone about RRSPs? Leave them with a parting thought.
The one thing I say to everybody about, their registered portfolio, and not just their registered portfolio, but any type of investment portfolio is, the best time to start was yesterday, and the next best time to start is today. So if you haven't started an RRSP, or if you haven't caught up on, the investment plans that you have already started, take the opportunity, get caught up, make the sizable the sizable contributions if you can, and really, take a good look at how your portfolio, your retirement plan has been working, or how it's been growing for you. And if it hasn't been growing at a rate of return that you think is going to get you, the lifestyle that you want, then give us a call and give us an opportunity to take a look at it, and we'll show you a different plan, a different road.
Okay, thank you. It was a good discussion.
Yeah, it was great. I appreciate it. Again,
obviously, if they have questions,
yeah,
call Clyde.
Yeah, always, always. Thanks again, Lou. We appreciate it.